Cayman,
the voice,
the heart, the soul of the Cayman Islands.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry and I'm delighted to welcome back to the show, by popular demand no less, from at least two supporters, Roscoe and Finley, if I'm not mistaken, the erudite and perspicuous Adam Newman. I'm trying to think of words to describe you, Adam, and that's the one that came out of the thesaurus this morning. Adam gave us all the benefit of his research on decentralised finance a few months ago, and we have had listeners asking for more. We are therefore delighted to delve into a new topic, but one which is incredibly unexpectedly apposite, insofar as all you read about now in the markets, in the financial commentary, is the threat of inflation. And we planned this about a week or so ago. We discussed this over a steak and we said, let's talk about inflation. And suddenly the world went a bit crazy about this topic. So Adam, you've got half an hour to tell us what the devil we need to know about inflation.
Good morning, everyone. Thank you for the introduction, Simon. Inflation is a topic we have actually touched on several times, and particularly from my sort of commodity perspective. So I would add that I'm not entirely unsurprised by the inflation prints that we've seen. This, in my opinion, was to be expected. And what I've talked about previously was that inflation, my expectations was for inflation would be a supply-led inflation, a crunch in supply chains, and rather than a demand-led inflation shock, which may come from a over-strong or overheating economy. What's really we've seen bond yields which correlate to inflation. We've seen bond yields rising, which means interest rates have been rising, which is a sign of inflation rising for a little period of time. And this again was sort of expected as the economy recovered from falling off a cliff last year. We've started to see economic growth improve, and so inflation tick up. But then yesterday we had a CPI, Consumer Price Index, inflation print out of the US, which far exceeded any economists' expectations. I think it came in at 4.2%.
Which is the highest something for about 12, 14, 15 years or so, isn't it?
Exactly. And so bond yields spiked. And growth stocks, which mainly technology stocks, sold off because they are very correlated to interest rates. And
this morning, while you're talking, and I know you wanted to be the one to break this news, but I'm sorry, I've got it on my screen. But you mentioned supply shocks, supply-driven inflation versus demand-driven inflation, and your point is that you're worried that supply shocks and inefficiencies or bottlenecks, etc., in supply chains may cause prices to rise. So you said yesterday we had consumer price inflation. This morning, just 3 minutes ago, we had producer price inflation. Okay. So that's the inflation that producers are suffering as they manufacture their goods and the costs that they're paying for raw materials and such like. So that, according to my numbers here, has come in at 6.2%, higher than the expected level of about 5.8%. So it's a huge increase in actual terms, 6% inflation on a yearly basis, which we've never seen before, if that would translate into consumer price inflation.
Yes, so we haven't seen these sort of inflation prints for a long time, and generally economists have felt that inflation was going to be subdued. We have a lot of labour slack in the economy because of COVID and because of the economic fallout of COVID. So this is starting to worry people. Why should we be worried about a higher inflation? Higher inflation essentially means more, higher price of goods for people. So it's a higher cost of living. I think the other bigger issue with inflation is, as we talked about bond yields, with a global economy which is drowning in debt, higher bond yields means the cost of servicing that debt goes up. So these are very real issues. Yeah. Now, the big debate is not whether we have inflation. We certainly do have the start of inflationary pressure. The Federal Reserve has said that they are not worried at the moment about inflation. They believe this inflation to be transitory, partly driven by the opening up of the global economy. This is all within their expectations.
And we're coming off, remember, we are now in May, and May last year was a very unpleasant time in the global economy. So prices were particularly subdued last year, and these are comparators to a year ago. So you'd always expect, coming off a horrible time, you'd expect things to be a little bit extenuated compared to what they would ordinarily be. So that's the transitory argument, I suppose.
Absolutely. In terms of transitory, these economists are the same economists who didn't see inflation coming. They've also said they would allow inflation to run hot for some time, and so it's really, where do we go from here? Where could inflation take us? We do have labour market. We still have a lot of labour market slack, but people are going to be starting to come back to work. So we should expect a demand shock, I think. So we've had a supply shock, and by the way, the supply shock, I think, will remain for some time. We still have supply chain disruptions. We've seen in microchips, but we also see in things like soft commodity prices. Wheat, corn, even oil, coffee have been going up a lot. This is partly driven by a weak US dollar. It's partly been driven by weather, which we've sort of spoken about on previous shows as well. But in terms of demand-led shock, we have, so people returning to the labour force, we have pent-up demand because people have been saving at an enormous rate because we've had nowhere to go and spend money. So this money is now going to be spent. And if you look at the sort of filings from many companies in the US and globally, companies' message is, we will be raising prices. Our input costs, which we talked about, and highlighted by the producer price index, input costs are rising. And because demand is improving and the labour force is improving, they are able to currently pass through those extra prices to consumers. But I would argue that the pent-up demand and the savings that consumers have, that's probably likely to be more transitory. Yes, we've got that because people haven't been able to go out, but these savings could be very quickly eroded if prices rise quickly. And so the issue there is that prices tend to be sticky. They go up a lot. People eat through their savings. And the economy isn't as strong as we think it is. And then we're stuck with, slower growth, higher prices. But the really big issue here is the Fed have said we will continue to support the economy for as long as it needs to be. And they've used employment as a measure of that. Unemployment remains very high, and so the Fed is very happy to continue to pump lots of liquidity into the system. But at the same time, you've got inflation rising, and the only way to stop sort of inflation, or the most orthodox way to stop inflation, is by raising interest rates. So the Fed really is stuck between a sort of rock and a hard place in terms of what they can do. They want to keep providing liquidity, but at the same time, that liquidity itself is driving up inflation.
I think that, to me, that's a really there's a couple of things that you've said there which I want to sort of digest and split out in a little bit. So on the one hand, you've said that there is unambiguously supply shocks around the world. So you saw that with the Suez Canal. You see it with the cost of trying to build a home. Even in Cayman, lumber prices are extremely high, and that is suggestive of there being issues in the supply chain. But the average person would be looking at this and going, we've just had a pandemic. We still are in a pandemic in technical terms. In other parts of the world, it's horrendous. How can there be an inflationary situation when people can't spend money? So this is your point. And that's the problem, isn't it? It looks as though there isn't inflation in terms of everyone's day-to-day lives just yet because people aren't spending the money and there's unemployment. But the worry is that percolating beneath the surface, which we haven't yet seen properly, are these unpleasantries, which were they to come out onto the surface and linger for a long time, would start to see quite rapid increases in car prices, in the cost of building houses, in travel prices, in hotel prices, in fuel prices. All those sorts of things would start to quite rapidly lead into the consumer. And that's the problem, isn't it? Because the Fed, so what you're saying is the Fed is focused almost exclusively on raising employment levels and ignoring these, not ignoring, but it's trying to ignore these factors. And if it continues to focus on that while these factors continue to bubble away and get more aggressive, then all of a sudden it might be too late for it to act preemptively and therefore have to do things that are perhaps a little bit more harmful to markets by acting a little bit more aggressively than it would otherwise have had to. Is that the essence of?
100%. And interesting, one of the sort of interesting phenomena with inflation is inflation expectations, which is another thing it's not a headline number, but where people expect inflation to go. And actually, the headline inflation doesn't matter nearly as much as your future expectations of inflation. If you have a future expectation that some cost of good is going to cost more in the future, it becomes self-fulfilling, and you end up driving the future price higher because people will
you buy it now, wait before it goes up, and that pushes the prices up.
Exactly. And so it's this inflation expectations that are rising as well, and that I'd say is more worrying. Plus you've got a Fed that's saying it's all transitory, not to worry, which is only perpetuating the issue. So you mentioned price of cars. Used car sale prices in the US have been exploding in price. I think they're up 10% year on year. House prices are exploding in price, and we hear many stories about people being paying 5, 10, 15, 20% over asking price. So
these are often signs of bubbles. That's a different way of looking at it in the same way. A bubble where you pay over the asking price is often associated with, you look back 10 years later and go, wasn't that so obvious? Why would anyone pay so much for an asset which was a depreciating asset? And then we find, well, it's easy in hindsight, of course.
Well, sitting behind that, you raise a very, very good question, is that the price of goods is going up a lot in the currency that it's denominated in. Okay. So actually, what we're also saying as this, or one of the big takeaways, is that the US dollar value of the US dollar's value is depreciating in all of this.
But it's not just the US that's seeing supply. I mean, the US is not alone in suffering supply shocks. Other parts of the world are suffering the same impact of, say, the Suez Canal being blocked or the lack of semiconductors. So other parts of the world are seeing the same sort of potential supply-driven inflationary problems. Why, therefore, does that cause the US dollar itself to devalue? Because it's not just the Federal Reserve that's put billions or trillions into its economy. The central banks of Europe, of the UK, Australia, they've all put trillions of dollars equivalent of liquidity into their own system. So why is the US dollar particularly exposed?
I mean, the US dollar is the global reserve currency, and therefore, global trade and stuff is denominated in that. And also, the US in absolute numbers has been doing the most amount of monetary easing, not in percentage terms. And I would also say the US dollar, I think the global policymakers are very aware the US dollar is when you're trying to foster economic recovery, a overly strong US dollar would actually derail that. So they are happy for the US dollar to fall in value, and they're actually got a very difficult decision to make. That you either raise interest rates, which affects the dollar, or if you want to keep interest rates down, you have to provide more liquidity, which pushes the value of the dollar down. You can't have sort of both. You can't have a strong dollar and be providing liquidity.
I think that's a very interesting angle to focus on, because when I was slightly younger, studied economics, it was defined often. One of the typical exam questions was, inflation is a monetary phenomenon, and you have to then discuss the implications of that. And monetary supply, to your point, by central banks has been a huge boost of supply, but that hasn't to date led to inflation in the scheme of things as we see it. So there's been trillions of dollars injected, but it hasn't led to inflation. So people will then come back and say, well, there's a new era, a new epoch under which we're operating. This doesn't work anymore, this historical understanding of inflation. So central bank action really doesn't lead to inflation. So how do you join those two rather disconnected ideas?
So we're in a very, very sort of unique period of time, and you talked about a bubble in many assets with a backdrop of terrible employment. I think what is different now is the debt levels and the supply side of the equation. We didn't have the supply shock, and we didn't have the debt levels that exist today.
And when you say debt levels, we're talking about US is about 110% of GDP. It's total debt.
It's total debt.
Whereas during the European financial crisis, Spain's was about 105%, and people went and pressed every panic button they could possibly find.
Yes, yeah, exactly. Any country you look around the world, like those debt levels far exceed anything we've seen in any other financial crisis.
Yeah.
And yet we're still taking on more debt because we have to take on more debt to pay down the existing debt.
Yeah. And then your argument then is, and we're going to come up to a break, I think, very shortly, but your argument is, if the central bank does something about this potentially endemic inflation, raising interest rates, because that's one of the very few ways you can actually control inflation. It's difficult to do it otherwise, because governments control fiscal policy, and governments don't like to raise taxes and cut back on spending, so you have to raise interest rates. If you raise interest rates when total debt is 110% of GDP, you raise them by 1%, that's potentially a doubling of interest costs. Well, interest costs are already a high share of budgetary expenses, so you double that share of budgetary expenses, which means your total debt burden, by definition, will increase.
Yes.
That's presumably quite problematic.
Absolutely. And so governments need to service that debt, so they end up printing more money, but they have less revenue, so they print more money also to provide spending on infrastructure. So we also have the other, and we could talk after the break, the fiscal backdrop, which is, not only do we have monetary policy spending, we now have huge fiscal spending as well, which is further exacerbating the problem.
Well, it's a spiral aspect that I suppose, if and when it happens, how do you actually stop that getting out of control? Because it is a self-fulfilling prophecy. So what does a central bank do about this? And they've been lucky, I suppose, over the last 10 years or so, with technological innovation has resulted in a lot of prices coming down. But now that supply shocks have disrupted the technological innovation impact, maybe they start to get unlucky. And then how do you actually cure that? So I think, if I'm not mistaken, our producer is probably going to lead us to a break right now, and then we'll come back and discuss exactly that point.
Radio Cayman, maintaining the innovation.
On a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note.
Can I send a request, please?
You don't really have to ask us. Just send a request.
This is a shout out to my ex.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Welcome back to Money Sense with Adam Newman and myself, Simon Caudry. In the first half of the show, we ruminated on the subject of inflation, talking a little bit about some of the economics and some of the practical impacts. And we ended the first half of the show with this concern that central banks have almost had it too easy in the last 10, 15 years. They've been able to get away with not having to concern themselves with inflation because there's been supply chain benefits. It might be that isn't such a rosy outlook in the future. And then, well, if that element of the inflation puzzle doesn't fit into the jigsaw as they would like, what does that mean for them? Does that mean that they could be an unpleasant spiral going forward? So let's talk about this. Let's see what you have to say on that one, Adam.
Yes, so I think the debt levels are the biggest concern now, as I say, with inflation. And what we should expect to see, I feel, is high probability, is as interest rates rise, we will hear more rhetoric out of the Federal Reserve about something called yield curve control, where you effectively suppress the interest rates. So the US 10-year rates will be possibly targeted to be within a certain range. We've seen it in other countries. We've seen it in Japan. Japan have been quite effective in doing this. But effectively, if you are doing yield curve control, the way you suppress or control those interest rates is by printing more money to effectively weigh down the interest rates. So if that's the approach, you want to hold down inflation rates because of debt levels, the outlet for that will be the US dollar, the currency, because you print more and more of the US dollar to hold down interest rates, and so you get a weaker and weaker dollar. Now it really doesn't help inflation. So my view is the Fed is really caught between a rock and a hard place, and I honestly don't know what I find it hard to see how the Federal Reserve get out of this. I feel that inflation will continue to creep higher, but you won't see it in interest rates necessarily. You will see it in a weaker dollar. And I think, thinking bigger and longer term, the more important question is what does that mean for savers and investment allocation decisions? And one thing I keep coming back to is, do owning bonds make much sense going forward? Bonds, have been traditionally bought, or traditionally, but not in recent history, bought for income. Not capital appreciation, but as central banks have pushed down the price of bond yields, you've actually seen a capital appreciation. But I actually think it doesn't necessarily. If you have yield curve control, bonds aren't going to offer you that much of a return, in my opinion, and therefore you need to look elsewhere. Now, the bond market is 125 trillion. The global bond market, it's like the most liquid, biggest asset class we have. So even if we follow my line of thinking, think that it no longer is as attractive, and some of that money is going to go elsewhere, where else might that money go? Certainly stocks, and we could end up going higher for stocks. But I think, as I mentioned, the US dollar in this scenario loses its value. So people will look for some store of value, some other means to sort of protect their wealth, which may be things like real estate. We may have to go even higher in real estate, particularly if they're holding down the cost of interest rates. So even though I talked about those, prices and people paying over the odds, that might be just the beginning of this. And I keep coming back to, you'll laugh, cryptocurrencies. This is a new asset class that has, ignoring today's news about Elon Musk, but, Bitcoin has proved as a store of value, a deflationary or disinflationary asset. And also it has the tailwinds of being a entirely new sort of technological change and asset class. So, I think the asset allocation decisions of previous years are no more, and I think we need to think much more seriously about other avenues and places to store wealth.
I guess looking at that, turning that around in a slightly different angle, and I'll see if I can make this into a question as opposed to just a statement. But the last 15, 25 years or so has been an investing environment associated with gently declining interest rates and technological improvement, thereby facilitating good returns for bond investors and very good returns for equity investors on average. Well, if the next 5 or 10 years are potentially associated with a necessary tightening of fiscal policy in order to pay down some of this debt that has been incurred over generations, and they're associated with a need for slightly higher interest rates, and they're associated with supply chain disruptions, then presumably logically turning the inverse of what happened on its head, you would have a somewhat average or sort of poor return for bond investors, and you'd have a potentially horrible return for equity investors, because the prospects of profitability for companies in an environment where taxation is higher, consumer spending is under pressure, interest rates, the cost of borrowing is higher, and the ability to pass on prices, you're suffering higher prices, could actually erode margins. And so it could lead to a very changed environment where we could see a substantial weakness in potentially almost all asset classes in order to readjust for the new environment that we face for the next 5 to 10 years. That's a possibility, presumably.
Yeah, and actually, there's an analogy with, I think it's the 1970s, but, to your point, with a similar backdrop of inflation and inflationary pressures building, the returns for bond investors were terrible. Equities fared better, and actually, I think the big question here, going back to my US dollar argument, is the return of equities may be okay, but in dollar terms, if the dollar is losing a lot of value, the absolute returns are poor, and it becomes a far more tricky investing environment for sure. We've all been used to rising bonds, rising value of bonds and equities, and it's been probably the easiest financial conditions and
exceptional profit margins for companies.
Yeah.
Because let's sort of drill down to very, very basic accounting, and I'm not going to pretend to do any decent, complicated accounting, but if the cost of the things that you manufacture are low, and consumers are willing to pay a decent price, you can make good money. If the cost of if consumers are not really happy to pay higher prices, but the costs of the things that you manufacture go up, your margins quite quickly collapse. And if you've borrowed money to finance that expenditure, you have this inverse leverage effect, which really hurts your business. It's great when you're expanding.
Yeah, and added to that, so the profit margins have been high for a number of reasons, a number of input costs, one of which is actually wages. Wages have stagnated relative to prices for a long time. We have a strange shift in demographics where there's going to be a lot of people leaving the labour force. Mm-hmm. So the actual unemployment headline rate we may never bring down to the levels we want, because I think there's a lot of people who have left the labour force and won't come back. So we might, and we're seeing in various industries, have a labour shortage. So that will be an added, tightening of profit margins if we start to see wages rising as well.
And that's an interesting point, because I think when you look at some of the debates that have happened over the last 2 to 3 years in terms of the political arena, one of the avenues, and this is one of our co-hosts, Emil, has talked about this, which is the burden of the perspective that people feel like they've been left behind and they haven't benefited from the extraordinary economic growth that has happened. They haven't felt that in their own wage pocket. They haven't felt that in their own take-home salaries. And then you've got this almost disconnected society with where the haves and the have-nots, the separation of the wealth between them has become ever more disconnected, so that it's increasingly associated with people who have wealth are getting ever wealthier, and those who don't are actually relatively getting further and further apart. And that's a problem for society, because it leads to unhappy people, and it leads to, in a French term, a revolution, and that's a dangerous thing for societies to face. But that's not to say that there's a revolution around the corner, but the aspects of it are the ingredients are there today for that sort of scenario. And obviously it can be much better managed because we can understand it, but that doesn't make it any safer as a landscape against which to invest against when you've got those discontenting factors that exist.
No, and I actually, and it's, we haven't got time to really dig into this. I think we're on the cusp of profound change, societal change, political change, economic change, and I think it's being driven by technology and information. And actually, there's a great book called The Sovereign Individual, which talks about we are transitioning from transitioning to the information age, which is going to completely throw what we thought about and how we thought about and interacted with the world into complete disarray. And it talks about how we started with the agricultural revolution, then we had the industrial revolution, and this is the next big revolution, and how governments treat their citizens will also change. Governments, who are now broke, I mean, it's hard to argue if they were a company that, you can't say they're broke, they will need to far better compete in this new information age for talent and for citizens and I think we see it on a micro level in various states in the US, in places like places that I follow closely more is Wyoming and Miami, which have reached out and trying to embrace the crypto community by making rules and regulations that appeal to the type of business and the type of people and talent they want to attract. Interesting, I think Cayman is a perfect example. It's been coined startup cities, but Cayman is a perfect example of somewhere that can not necessarily reinvent itself, but put itself out. And I think we've seen it a little bit with the Global Citizen Programme. Cayman has an awful lot to offer.
All 60 people.
all 60 people. But, on a micro level, that
a resounding success. Let's not dwell on that one.
But yeah, looking forward, Cayman could potentially be should be a very attractive place to attract talent and capital. Should be
if done well.
Yes. I mean, I have plenty of thoughts about that, and maybe that could be a whole nother topic.
I got 1 minute, or just less than 1 minute probably. Are we going to? We started this show with talk about supply chains. Are supply chain problems easing as we speak, or are they likely to worsen? Is that something because inflation is just a number, right? But it is driven by other things, and so percolating beneath, should we continue to be worried about supply chain issues?
answer it slightly differently. Do I think inflation is transitory? No, not anywhere near as transitory as the Fed will assume, and I think it's going to be very hard to put that genie back in the bottle. Specifically in terms of supply issues, yes, as the world opens up, we should expect some easing. So in terms of supply issues, I think we're probably close to the peak in the next couple of months, and we should see easier prices. But commodity prices are not only supply chain driven. It's other things. It's
demand can take over.
It's demand, absolutely, and it's years of underinvestment which take a long time to sort of remedy. But I am on the side of believing that inflation is not as transitory and will exceed the the goals or the levels that the central banks are comfortable with, and therefore force a hand into things like yield control and have an effect on
and higher interest rates and all the rest of it. Adam, we are, as always, wishing to talk more but unable to. The news is around the corner, or the next show is around the corner as well. Thank you again for rejoining. Appreciate your perspective. If I remember correctly, your Twitter handle is @from_10,000 feet, 10,000 in numerical terms. There you go. If you understand Twitter, then go on there and do your worst. Or @MoneySense Radio is our Twitter handle. So thank you again to our listeners for tuning in. We will be back in 2 weeks' time. If you have any topics or questions or items you want us to consider, email us or tweet us at MoneySense Radio. Our email address is moneysense@candw.ky. With that, thank you and goodbye.